Top 25 growth stocks in the S&P 500. I went ahead here today and I ranked in order the top 25 S&P 500 stocks based upon revenue growth in the last 12 months. And what we're going to go ahead here today and do, we're going to go through all these different stocks. What stocks are these in order? And also, do I think any of these stocks are buys? Do I think they're not buys? Do I think your money would be wasted if it's in some of these stocks? So we're going to get into all that. It's a lot to go through in today's video. We're not going to go super in depth in these stocks. This is going to be a quick overview of kind of my opinions on if any of these stocks are buys or not. Okay, I appreciate every single person for joining me here today. Thank you for being subscribed to the channel. If you're new here, I'm Jeremy. Welcome in. If you're looking to apply, join my private stock group, get access to all my best courses, access to my 6-7-figure Discord chat, pin comment down there. Alrighty, guys, let's get straight into this. So, in terms of the first stocks up here, the number 25 best growth stock of this past year is a company named Cummins in the S&P 500. They've had 27% revenue growth. Tesla is the number 24. We'll speak about that in just a moment. 28% growth for Tesla. Booking Holdings, number 23 with 28% growth. United Airlines, number 22 with 28% growth. Gen Digital, 31% growth. And number 20 is Enphase Energy, 34% growth in the past 12 months. So let's go ahead and start going through these, okay? So Cummins, first off the bat, it's expected to have revenues go down 2% next year. Not something you ever want to see, a company's revenues going down, especially for the upcoming year. It's one thing if it was in the past and it's like, okay, that was our hard time, now we're moving past that. It's another thing when it's like, oh, we're about to go through a hard time, right? On top of that, EPS is also expected to go down and be in the negative for this company. When I say the negative, I just mean it's supposed to go down for the company on a year-over-year basis. Now, I also saw this just came out here in the past, let's call a week and a half. Cummins to pay a record $1.675 billion civil penalty in vehicle test cheating settlement. So this is going to be a massive kind of one-time expense for the company overall, and so that's a huge expense for a company that is the size of this company. I mean, the entire market capitalization of Cummins is just over $30 billion, so to have a nearly $2 billion penalty is massive. So overall, when it comes to Cummins, I kind of look at the stock and I say, it's not something I really want to be involved with. Not my cup of tea, okay? Tesla's next up here. Now, if you've been following the Tesla story, you know Elon Musk and the team has lowered price consistently for pretty much the past 12 to 18 months, and they're trying to take market share right now in a tougher auto environment. So for Tesla overall, the good news for the company is they are expected to get back to EPS growth in the upcoming year. So that's a situation I do like when a company is expected to get back to growth rather than they're about to go into a business of decline. That's where it definitely differs from something like a Cummins, right? Now, when it comes to Tesla, there are companies that's putting up 20% plus revenue growth expected over the coming years. If interest rates were to come down, Tesla might be able to put up better numbers than that overall. So in my opinion, Tesla's a buy at the moment. There might be better opportunities over this next 3 to 6 months if there can be even some more weakness in the stock, if they report a weak earnings, if they report margins going down more. But this one could flip at some point in 2024 and start a lot of upward momentum at some point this year, because likely they're going to trough earnings in the next 1 to 2 quarters. At least that's my opinion in regards to Tesla. The number 23 growth stock in the S&P 500 is a company named Booking Holdings. Some people might know it as Booking.com. So this one's okay. It's got expected to have about 17% EPS growth next year. 26 analysts cover this stock, by the way. Expected to have 10% revenue growth. So I like that their earnings per share are expected to increase more dramatically than revenue. So I think it's an okay stock overall at a decent valuation. The only thing I would kind of worry about a little bit here is an overall travel slowdown. We have had a revenge travel last 2 years. 2022 and 2023 were kind of revenge travel years for the consumer, and we're probably going to go a little bit more into a more normalized environment. So that's something that could maybe weigh on this company, but I think it's okay. I think it's an okay buy here for Bookings. Next one up here, number 22, is United Airlines. This one trades insanely cheap. It trades at a forward P under 4. It has a revenue growth of about 5% expected next year. Airlines always are going to trade extremely cheap. It's just how it is. Usually the only time you'd ever have to pay a high forward P is if you just went through a massive recession for airlines or something like that. But yeah, usually they're going to trade at, we can call it anywhere between about a 3 forward P and about 8 forward P or so. This is just how these companies usually trade, okay? Now, I think it's a fine buy. Do I think it could be a moneymaker? Sure. Do I like the airlines? Not really. Do I really want to own airlines personally? Not really. But I do think it's an okay buy out there just because it trades so dirt cheap for these sorts of companies. Number 21 is this company named Gen Digital. Now, they just did this this big merger, and they're going to have much elevated debt levels. So it is something to keep in mind with this particular company. Now, looking at this company, forward P is about 10 on this one. Expected to have 4% revenue growth for next year, so that's okay. So I think this one looks okay. Just be careful of the debt load in regards to that one. Next up here, Enphase Energy, number 20. So Enphase has entered some tough times here very recently. I mean, this company went through kind of a boom period for the last 5-10 years, and just very recently, as in the past, I would say probably 2 quarters, all of a sudden it's gotten into some trouble here. Okay. Now, for Enphase Energy, they're expected to have their EPS go down next year. And this company is expected to be based upon what next year's EPS is expected to be, based upon 33 analysts covering the stock, about at 25. I have a lot of question marks if they're even going to be able to come through with that number analysts do have there. Now, in terms of revenue decline, they're expected to have revenue go down about 17% for the company next year. So I think analysts are probably too high with the EPS projections in regards to Enphase, especially hearing their last conference call, kind of the problems with inventory in the channel and those sorts of things. So I think there's a potential Enphase could be an energy trap, a value trap over this next several years, especially if we get a recession in the next 24 months. That's the thing that would really add insult to injury here with Enphase if we did go through a recession in the next 24 months. But I think even regardless, I think this one could be potentially a value trap here for a bit. And the reason being is it's not trading that cheap, to be honest, and I think analysts are too high with their numbers. I think, I don't think they're doing $4 plus next year. Maybe they do, but I just don't think it's very realistic. And so that just puts this company in a really tough situation, especially with the interest rate environment being where it's at right now. The Fed is expected to lower rates at some point this year, but there's still a lot of question marks about how fast they're going to lower. And the only way usually the Federal Reserve lowers rates rapidly is if you have a major deterioration in the economy. If you have a major deterioration in the economy and unemployment, ticks up in a major way, that's gonna hurt Enphase Energy in quite a considerable fashion. So Enphase, I'm a little worried this one could be a value trap here, okay? Alrighty, next one's up here. AXON Enterprises, number 19, M&T Bank, number 18, Nextera Energy, 17, and Live Nation, number 16. Those ones are coming through with 36%, almost 37% revenue growth, 38% revenue growth, 38% revenue growth, and 40% revenue growth for these ones. AXON Enterprises, they're in with the government. That's good, and especially on the state side. They make a lot of the tasers and camera-related products for police officers and those sorts of things, and they have the big cloud business. So they have a pretty, I would say, an extremely stable revenue base for the next 10 to 20 years. So that's a good thing for this company. The bad news for this company is earnings per share is hardly expected to go up next year, only 6% expected, trading at a forward P of 60. So you're going to pay a premium for a company like this because they have those government contracts, those state contracts that, it's like, they're gonna continue to renew and use the cloud data and all those sorts of things. But on the flip side, revenue growth is expected to be 21%. So the fact that only 6% revenue EPS growth is expected, while 21% revenue growth, that makes me a little wary, because usually that's not a very good sign. You usually want to see your earnings per share increasing more rapidly than your revenue. So this is complete opposite situation of that. So I don't know. I look at this one and I think it could be steal money for a bit. That's the best way I could put it. There's a potential that this one could be steal money for 2 to 3 years in regards to AXON there. Okay. Number 18, M&T Bank. This is one, EPS is expected to go down for them in 2024. That's not great. Trading at a forward P of about 9, which banks always trade very cheap forward P-wise. Pretty much always under 12 for the most part for banks, and a lot of times under 10. So That's to be expected. Revenue is expected to go down for this company as well. Over 5% revenues down expected in 2024. So, I think this one's just kind of a waste of capital, an M&T bank, because here's the thing. If I want to own a bank, I want to own the best. The best is JP Morgan. So if I'm going to put money anywhere, I want to put my money with JP Morgan. If I had to pick something outside of JP Morgan, I'll go to Goldman Sachs. But yeah, not looking for somebody like an M&T bank. I think that one's probably just a little bit of a waste of capital in my personal opinion. Number 17 is NextEra Energy. This one, as far as next year's numbers, expected about 8.7% EPS growth, trading at a forward P of about 17. 3.6% revenue growth expected for the company. So I think this one's okay. Not my favorite, but I think it's kind of meh, an okay stock. Live Nation. Okay, so this one's getting really interesting here. So Live Nation, you should know them as Ticketmaster and all the other, very popular websites and apps and things like that you use to maybe get tickets to a concert or maybe a live event of some kind. So here's the issue with this company, okay? 7% revenue growth expected. First off, I'm not even sure they're going to be able to put up that number next year. That's a big question mark to me. But let's say they do put up that number. I don't think it's going to be a very good sign because of what's going on with the government that we're going to get into in just a moment. 35% EPS growth is expected. I don't think they're going to put up that number. And if they do put up that number, it's going to make the government a lot more mad, which isn't going to be good. And the company's trading at a forward P of about 42 on this stock. So now also remember, we went through, just like we went through a revenge travel period for the last couple of years, we went through a revenge concert cycle and getting back out into the real world cycle over the last 2 years. 2022 and 2023, everybody was cooped up in their homes and apartments and things like that. 2020, 2021, a lot of live events weren't even going on. So 2022 and 2023, people were just waiting to get out there and they couldn't wait to go see their favorite musicians. They couldn't wait to go to the live events and all those sorts of things. That's a little played out now. And so now we're just kind of getting back into, in my opinion, a more normal demand environment, which could obviously weigh on ticket sales, especially given that, this isn't 2022 anymore when people were very flush with cash, when they hadn't already really been hit with inflation yet. Inflation really took its toll over the last 2 years, right? And so the consumer's in obviously a much weaker place than they were 24 months ago. Now, the problem with Live Nation is the government's after them big time. The U.S. Senate is starting to get fed up with Live Nation. U.S. government investigation into Live Nation. I mean, they just issued a subpoena back in November. A subpoena is something you're forced to basically respond to when the government's after you. So, yeah, no bueno. This is not a good situation for Live Nation overall. I don't know how this ends, but I don't think it's going to end good. And look at this. Live Nation has stonewalled my subcommittee's inquiry into its abusive consumer practices, making the subpoena necessary, says the senator. So, the way he puts that there, it sounds like a verdict's already formed. Into its abusive consumer practices. That sounds pretty much like a verdict's already formed in this situation. And so I don't know where this is going to go for Live Nation, but I don't think it's going to be good because, they're not going to be able to show big profit. If they show huge profit increases while the government's after them, it's such a bad look, man. It's such a bad look. It's going to make the government even want to go after them even more, okay? So, and the Live Nation, I don't want to touch that one. If anything, I would be inclined to buy puts rather than go long, okay? Next one's up here. Number 15, Lamb Weston, 40% revenue growth. Arista Networks, number 14, 42% growth. Prologis, 43% growth. Number 12, Arch Capital, 43% growth. Cincinnati Financial, 44% growth. And Wynn Resorts, number 10 there, 50% growth. So, in regards to Lamb Weston, I think this one's okay. It's kind of a meh situation. So they're already in their fiscal year because their fiscal year ends in May. Keep that in mind. So 27% growth expected this year. Trading at a forward P of about 18. 10% revenue growth expected next year. 9 analysts have those numbers on average, right? Forward P of 16.6, 28% revenue growth this year, but all the way down to 5.7% expected next year. So it's quite a deceleration. So I think this one's okay. It's not really my cup of tea. It's okay though, okay? Arista Networks. So this one looks very expensive, right? Forward P based upon 2024 numbers of 34. With that being said, company is a double-digit grower on the bottom line and the top line, okay? And this is a great company. I would say definitely one of the better S&P 500 stocks in the market. I wouldn't call it the best, but it's certainly one of the better ones. One of the most well-run companies, just phenomenal. And its stock price shows. I mean, the last 5 years, the stock price has gone up over 300%. So Arista Networks has been just a phenomenal company for a long, long time. And I think they're going to continue to be a phenomenal company for at least quite a bit here into the future. Number 13, Prologis. So this one's weird, okay? Because here's the deal. 13% revenue growth expected in 24 for this company. Great. But here's a weird thing. Only 9 analysts have revenue numbers, yet 23 analysts have EPS numbers. Very, very strange. And then EPS expected to go down for the company on a year-over-year basis with 13% revenue growth. That doesn't even make sense. Trading at a forward P of 22. So I don't know, man. It looks like it might be okay, but there's some weird stuff going on. It's almost like it's a trick in regards to this stock. So that's one you would have to do a lot more digging on to find out what's going on there, because you're not usually going to see a company had their top line going up 10% plus with a revenue, with an EPS in decline. Very, very strange. So I don't know. That one I don't trust. Let's just put it that way. Number 12, Arch Capital. This one's EPS is expected to go down in 2024, while their revenue is actually going up 13+%. So Arch Capital, not one that's interesting to me at all. Cincinnati Financial, trading at a 17 forward PE. No, thank you. I don't want any financial related, bank related, trading at those sorts of valuations. No. Like I said, if I'm going to play in anything, give me JP Morgan. If you're going to force me something outside of that, Goldman Sachs, outside of that, I don't want anything else. I don't want Bank of America, don't want Wells Fargo, I don't want Cincinnati Financial, M&T Bank. I don't want any of those. No, thank you. Number 10, Wynn Resorts. So we have a pretty interesting dynamic here with Wynn Resorts. So companies expected to be trading at about 19 times 2024 expected numbers. 48% EPS growth expected for this company. 15 analysts have numbers out there. And then if you look at revenue growth, 8% expected revenue growth in 2024. So this is a phenomenal situation. I love it if a company is increasing their bottom line much more rapidly than their revenues are increasing during that time period. That means much more of every dollar is reaching the bottom line. That means they've already gotten to a level of scale, and now they're just starting to produce massive profits. So I like the way Wynn Resorts is lining up here. I think Wynn Resorts is a buy for years to go in the future. Next one up here is VICI Properties. We'll talk about that one. Number 9, 55% revenue growth over this past 12 months. Nvidia at number 8, 57% revenue growth, which, by the way, currently they're now starting to put up like 200% revenue growth. So this is obviously looking at the past 12 months. Berkshire Hathaway, number 7, 58%. Warner Brothers, number 6, 61% there. Now, VICI Properties, this one is, I think it's a solid landlord, I call them, okay? Kind of REIT-related play. Trading at about 11, 12 times, EPS growth expected in 2024 of 8%, revenue growth of about 5%, a little under 5% expected for next year. They own a lot of the land in my city, Las Vegas here, and I think it's a solid landlord play. Not the most exciting stock by any stretch of the imagination, but it's solid. And by the way, if you're wondering why was our revenue up so much, that's because of some deals that went through last year that those aren't going to be, obviously, now they have to lap those numbers on a year-over-year basis. So look at this, 10 trophy assets on the Las Vegas Strip, the Venetian. Now, keep in mind, they own the land in the buildings, but they don't operate inside the properties. So it's not like some big baller comes in and gambles $10 million on a weekend and loses. Not like they really get the benefit from that because they have operators operating in all these properties. Some of them it's MGM, some of them it's Caesars or others, okay? And so they're just a landlord. Just think of it as that, okay? So, yeah, New York, MGM Grand, Excalibur, Mandalay Bay, Luxor, Park MGM. Some of these are good assets. Some of them are not very good assets, I'll be honest with you guys. And so I do have questions about what happens when they need to tear down. Because if you understand Las Vegas, properties need to be torn down over time. They get outdated. The Mirage, it's still okay, but they're going to need to tear that down in the next decade, I would say. Caesar's Palace is okay for now. Harris needs to go bye-bye at some point in time. New York, it's okay for now. It needs to go bye-bye in the next 10 years. MGM Grand should go bye-bye in the next 10 years. Excalibur should go bye-bye in the next 10 years. Mandalay Bay is okay for the next 10 years. Luxor, it's cool to look at, but it should go bye-bye in the next 10 years, to be honest. And Park MGM, I think, is fine for now. So they own, the problem is a lot of these properties need to go bye-bye. If you keep them up and running, you're going to have more properties that hit the market over time that you're going to have to compete with, and you're going to get beat, right? And that's a problem for you. You have to have the new fresh product that people love, or you're just going to be stuck with kind of having lower end consumers kind of at your properties, and you're going to have to collect lower room rates. So I don't know how that's all going to work out. Also, when times are good, I think the landlord has a lot of position of power over these companies to get further increases in rents, but whenever tough times do come, these guys are going to have all the leverage in the world, because the problem is the landlord's not going to be able to get another operator in there. Like, you're not going to get another operator all of a sudden take into account the Caesar's Palace. Like, that's not how it works. Like, if Caesar's Palace couldn't make money, let's say at a given moment, who's to say some other operator could come in and make money? They're not. So that, I don't know, man. Like, it looks okay, but I think it could get messy. I think it could get messy over time. But as long as things are okay, there's no huge, great financial crisis type situation, I think it's fine. Dividend yield is a 5% plus on this stock, so I think it's okay. I think it's okay, landlord. Not my cup of tea, though. Not my cup of tea. Number 8, Nvidia. Let's be very clear about Nvidia. The stock's pretty much always a buy. It's likely on a run to 1,000 right now. I think it will probably have a big pullback after 1,000, but it's on that big run right now. There's a massive, obviously, infrastructure cycle going on for their AI chips. That's going to last at least another 1 to 2 years before that really starts to slow down in any meaningful way. So for right now, their numbers are going to continue to be great. For 2025, they're expected to have 63% EPS growth. Now, they have also been coming in and trashing numbers, so maybe they come in and beat that substantially. Only trading at a forward P of 28 times 2025 numbers, or, January 2025, that is, so really it's 2024. It's incredible. Revenue growth expected at 55%, so I wouldn't be surprised if that EPS number ends up being low. So Nvidia's always a buy. The stock's probably running to 1,000 plus. And then after that, we'll probably have a big pullback, maybe a year from now or 2 years from now or something like that. Whenever that cycle starts to kind of, the parabolic growth starts to tame down a bit, that's when people start getting worried about maybe, because NVIDIA, they go through these massive cycles, then there's kind of a taper off, and then all of a sudden they go into decline. And the decline can last a few quarters, maybe a couple of years, and then all of a sudden they have their next big runway of growth. So that's likely the story here with NVIDIA here for a bit. Now, number 7, Berkshire Hathaway, another stock that's always a buy. Not the most exciting stock. It's not going to knock your socks off, but they have massive, great investments, some of the best companies in the world in terms of ownership. They also own outright many phenomenal companies. The stock's always a buy. It trades fair. It's a simple, great stock to own. Playing Berkshire Hathaway is almost like playing the S&P 500. That's the way I look at it. It's just a little more concentrated S&P 500 play. So, if you had to ask me what outperforms what over the next 10 years, Berkshire Hathaway or the S&P 500, I would say they probably are going to perform roughly in line. That's my opinion over the next 10 years. We'll see, though. Number 6, Warner Brothers Discovery. So don't like this one. No, I don't. Here's a problem. Only 1% revenue growth expected next year in 2024. Well, really this year now, 2024, right? 25 analysts have those numbers out there. On top of that, they're expected to lose money in 2024. They are expected to finally flip to profitability in 2025. But if you look at the profitability expected in 2025, and once again, it's a question of, are they actually going to be able to get to profitability? But let's say they do. They're trading at about 26 times 2025 numbers. I don't want to pay 26 times 2025 numbers for a company that's losing money right now, and that has 1% revenue growth. Like, no, thank you. So Warner Brothers Discovery, I have no interest at all in that one, okay? Next up here, so 5 is Albemarle Corporation, Royal Caribbean, Carnival Cruise Line, Norwegian Cruise Line, and Las Vegas Sands. So basically it's Las Vegas Sands and a bunch of cruise operators for the most part in this top 5, okay? Las Vegas Sands, I think it's a buy. With that being said, we're trading at about 17 times 2024 expected numbers, 46% EPS growth expected in 24. And then the revenue growth expected for Las Vegas Sands is 18%. Now, do keep in mind, they do not own or operate the Palazzo or the Venetian in Las Vegas anymore. Okay, so this is really now at this point in time, it's a heavy play on Macau. It's a heavy play on Singapore because they own the Marina Bay Sands in Singapore, which is just an incredible property. I gotta make a visit there at some point in time, swim on that pool up on the roof, man. Oh, man. But in regards to LVS, it's a buy. I just like Wynn better. I think Wynn's a more focused company. I think Wynn has, in my opinion, even the more trophy properties in Macau and in Las Vegas, and obviously Las Vegas Sands. They shouldn't even call it Las Vegas Sands anymore because they really have nothing to do with Las Vegas anymore now at this point in time. They should call themselves Macau Sands. But I look at Wynn, I look at their property in Boston, their properties in Las Vegas, their properties in Macau, and they're just higher end. They attract the most VIPs of VIPs, and that's really where I want to play, especially if I'm playing in a gaming related company like this. So LVS, a buy. I like Wynn better over time. Okay. No, cruise operators. I'm just going to lump all these guys kind of together, and a lot of their stocks kind of move together. Now, they can outperform one another a little bit here and there, but at the end of the day, they're going to kind of move together. Now, Royal Caribbean has the most hype right now because they just launched a new massive ship. I believe it's called Icon of the Seas there, and then they got another massive 1 to 2 ships hitting over this next 6 to 12 months, which is very exciting. So they might have the most hype and excitement out of all the players, but I love these cruise operators regardless of the economy. They've already gone through their D-Day. They already went through their D-Day. Their D-Day was Rona. That gets no worse. Recessions, anything, pretty much from here. That was the worst case scenario. The fact that they couldn't even operate their cruise lines for, what was that, like a year and a half, 2 years? It literally gets no worse than that. Whatever these companies ever have to go through in the future is going to be better. Now, unfortunately, almost all these cruise operators, or pretty much all these cruise operators, are entering the following years with much bigger debt loads than they had previously. So that is something that's going to weigh on all these businesses and for all these cruise operators. So it is something to keep in mind. But I do love these cruise operators regardless of the economy. The economy is good. People are going to go on cruises. The economy is not good. They're still going to go on cruises. The baby boomer generation is all starting to reach retirement age, or they've already retired, and that's going to bode very well for these cruise operators for the next 20 years. That's the thing. It's not just like, it's a 1 year, 2 year benefit. It's the next 20 years. These cruise operators are going to benefit massively from the baby boomer generation starting to retire, and they're going to go on a lot of cruises over this next couple decades. This is just a very popular activity overall. And the thing I love about the cruise operators is their product is so affordable that they can meet price points across the board. They can sell to a consumer that might be a higher end consumer and have certain cruises for those folks, but they can also sell to more middle class, and they can even sell to, even folks that, wouldn't usually be able to afford a very nice vacation to maybe other places, right? Check this out. I want to show you guys kind of, the proof in the numbers, okay? This is a 4-day Baja, Mexico, Long Beach cruise. So you get on in Long Beach, right? Then you go to Catalina Island, then you go to Ensenada, and you end in Long Beach. And it's incredible because it's under $1,000 for 2 people for everything. That's your drinks, your food, all that stuff, right? And your lodging, obviously, for under $1,000. I even put it in with gratuities already prepaid. So if you prepay your gratuities, they had an extra $128 here. Your total, and this is after taxes, fees, port expenses, everything, for 2 people, $925 for 4 days. I mean, if you've gone on vacation recently, you know how expensive vacations are. Extremely expensive. The fact that you could go on a 4-day cruise with your drinks and everything included and your food included, that's pretty darn good. And so that's what makes me very comfortable in these cruise operators. I don't own any at the moment, but I might eventually own these cruise operators. And also, obviously, if the economy is great, then you could talk about oil prices are a little more expensive in that sort of environment, and so that hurts the cruise operators, but then you can get more per room, obviously, and your demand's much higher. But then if the economy is a little weaker, right, that means oil prices are likely going to be weaker, and so maybe you're not as able to have as many people on the cruise ship, or you have to sell at a slightly lower price, but you're also getting your main cost is fuel expense, which isn't going to be as high in that sort of environment, which bodes well for you. So I think these cruise operators are looking pretty darn good. They already went through their worst case scenario, which was being shut down for 2 years. That was incredible. Okay, I appreciate y'all joining me as always. I hope you got great value out of this video here today. Make sure you subscribe to the channel if you're not. If you're looking to apply to join my private stock group, you want access to all my best courses, access to 6 to 7-figure Discord chat, access to see the moves I'm making in my nearly $2 million $10 Fidelity account each week. Then check out the pinned comment down there, fill out an application. We can see if we can get you in there either this weekend or next week. Much love and have a great day.